The 37% highest tax bracket for a trust starts a little over $13,000 of income.
You got Elisa. Elisa. She goes, "Hey, Joe, Big Al, it's me again. Please clarify trust taxes for us.
Okay.
If assets are in the trust, let's say, for example, non-Roth mutual funds, which I believe are usually taxed at 15%, but now are in the trust, are they taxed at a much higher rate? What about bank accounts and home sale proceeds? How much is the trust going to cost in taxes? Did I make the right decision in setting up this trust? I understand there is high estate tax limits, but what are other taxes involved? Thanks for educating us and being so funny." Well, thank you very much. Great question.
This is a good question.
So, yeah, this is why this whole financial planning business is a little confusing, because there's two different types of trust.
Yeah, exactly.
There's an irrevocable trust and there's a revocable trust.
Right. So let's start with revocable, which is what most people have. Most people have a living trust. A living trust is a see-through trust. It's as if it weren't there. So in other words, the trust earns interest and dividends because you're supposed to put your trust name on your bank accounts and your brokerage accounts, but there is no trust return because it's a see-through. So it's like it doesn't exist.
For tax purposes.
For tax purposes, right. For tax purposes. And so interest, dividends, capital gains show up on your tax return. That's the most common case. Okay. So maybe with Elisa, we'll assume that this is a revocable.
Yeah.
Yeah. So and
what this trust does for her is that it avoids probate.
Yeah.
So she did the right thing, depending on what state that she lives in. Let's say she lives in California, where we're at. Is that all right? You set up a living trust, and when Elisa dies, right, then the successor trustee takes over and distributes the trust to the beneficiary, and it avoids a whole probate process. It's probate is lengthy, it's expensive, it's public record. There's a lot of negatives to probate. So people want to avoid that process for their heirs. So they set up this living trust, and basically it avoids all of that. So it's just another entity that you title your belongings to. But for tax purposes, it's a see-through.
Yeah. Now there's a couple ways you can end up with a revocable trust, which is completely different. Irrevocable. Thank you.
Mm-hmm.
The first one is the living trust. It used to be common to have an A trust and a B trust. And when the first spouse passed away, half the assets were put in one trust, half the assets were put in the other trust. Typically, the B trust then became an irrevocable trust and paid its own taxes, unless the income was distributed, which can be. If the income is distributed, then the trust doesn't pay the tax, it goes to the beneficiary. So that's one way to get an irrevocable trust. Another way is to just simply set one up. And you would do that if you have a lot of assets and you're afraid about estate taxes. You put assets that have a potential for high appreciation in the irrevocable trust, so you get it out of your estate. But now that trust has to pay its own taxes. And the tax rates for the trust are the exact same as individuals. It's just that you hit the higher brackets much, much, much sooner. For example, the 37% highest tax bracket for a trust starts a little over $13,000 of income. So it's not like 500,000 or 600,000 of income, it's 13,000. And the highest capital gain rate of 20% starts at also a little over 13,000. So if it's a irrevocable trust and you're not distributing the income from that trust to the beneficiary, then the trust itself has to pay the same rates as an individual. It just hits those higher rates much sooner.
And I think where we've talked about this in the past is for those of you that named a trust, your beneficiary of your retirement account. And the only reason why people would name a trust is to control the assets after you passed, right? Is like, hey, Junior can't handle these assets, so I'm going to set up a trust. The assets are going to sit in trust, and then the trust is going to distribute out the money when I decided to before I died. So that's an irrevocable trust. The kid couldn't get into the trust and say, give me more cash. The trustee would be like, no, here's the rules of the trust. It's irrevocable, and it's set up on XYZ, distribution schedule, whatever it is. But if it sits in there, and it gets more complicated than this, if it's discretionary or non, a conduit trust or whatever, and we are not attorneys. Let me just explain that real quick. But if you have an irrevocable trust, the money sits in that irrevocable trust and it produces income that's not distributed to the trust to another entity, then the trust is going to pay those taxes at a higher rate.
That's right. And typically, Joe, as far as distributions, it would be common to distribute interest and dividends from an irrevocable trust. You don't have to, but it's not uncommon. It's less common to distribute capital gains. So capital gains are often stuck inside the irrevocable trust unless the trust document allows it.
So that was clear as mud.
She's going to ask another question next week.
But I think for most everyone that listens to our program is that, if you have a living trust, it's a see-through trust. It's going to be taxed at your normal rate.
Yeah, don't worry about it.
If you have the trust as the beneficiary of your retirement account, I would highly reconsider that and look and change this, because the rules have changed.
Are you prepared for retirement? Schedule a free financial assessment with an experienced financial professional right online at purefinancial.com.